Should we get started now? I think Ryan's looking at our numbers. Do we have
Yeah, go ahead.
people? Okay, all right.
Let's go ahead.
Sounds good. Well, welcome everyone. Thank you for joining us this morning. We're going to be talking about considerations for family offices when they're investing in the fund world. I first have to start off by also mentioning this disclaimer that we have, that we are not providing specific legal advice. We're talking about these concepts generally and sharing our own views on these concepts. Also on this slide, we have information about CLE credits. If you have any questions, please feel free to contact Sydney Sachs, whose email is here. Also, in order to have credit, we have to ask a few polling questions during the presentation to make sure that you are engaged and paying attention. So we will pause to have you answer those polling questions along the way. We'll also each introduce ourselves as we come along in the presentation. I'm joined today by Leah and Ryan, and each of them will share a little bit about themselves when they take the mic. My name is Amy Bowler, and I am a partner with Holland & Hart. I've been here 22 years. I'm currently the chair of our securities group, and I spend my days working on securities and M&A matters, including advising family offices. We thought that we would start off just talking about the family office itself. Family offices do get involved in funds from a number of different perspectives. Sometimes families form funds themselves to do investing for the family. And inevitably, even if they don't form funds, they're investing in funds. But it all starts with the family office. As most of the attendees probably know, the reason you're here is probably that you're affiliated with a family office in some way, shape, or form. Many wealthy families have family offices, and they may do a variety of different things for the family. But many times the quote family office, which sometimes is an entity and sometimes is a concept, frequently they get involved in making decisions about how to invest the family's money. And also what types of advisors that the family might want to engage to assist with investing. If family office members are being paid and as part of their job, they are advising about securities or advising about what professionals to assist the office, all of those activities can subject you to SEC regulation. You are considered to be acting as an investment advisor when you engage in those activities. So if you're engaging in those activities, the next question is, do I need to register as an investment advisor, or can I rely on an exemption? Frequently, family offices, if you're part of a family office and you're working for a single family, you have the ability to utilize a very user-friendly exemption that we refer to as the family office exemption. The family office exemption, I'm going to try and click here. The family office exemption says that if you're part of a family office and the family office is only advising what are called family clients, and we'll talk a little bit about what that means in a second, and the family office is wholly owned by family clients and controlled by family members is a subset of family clients, and the office doesn't hold itself out to the public as being an advisor, then you may be able to utilize the family office exemption. The family office, when we talk about who are the clients, the family clients who can receive advice, this includes family members, and we said there's a subset of the family clients, family members who have to control the entity. Family members includes 10 generations. You pick an ancestor and you have 10 generations away from that ancestor, and all of those folks are considered family members. In addition, typical types of family entities that you would have in a family structure family trusts, or funds that we're going to speak about today, family funds that are intended to invest family assets. Those types of entities are also covered as family clients. And then finally, key employees are covered as family clients. And key employees would be the officers or directors or equivalent of the family office, or those who are involved in making the investment decisions. So there can be a small group of people who goes beyond what you would think of as the family and the family entities, who can also be advised. One place that we do find some issues sometimes is when someone is trying to assess whether they can meet the exemption. Usually they look around and say, well, with a few tweaks here and there, we're probably good. We probably satisfy the exemption. The one sticking point can be foundations. Sometimes families have charities or foundations. And the rule is they can receive advice from the family office, but they can't, but it has to be fully funded by the family. They can't have outside funding. So there are two ways to address that. Either it's to limit the funding to come from family members or family clients, or it's to seek a different advisor for the foundation or the charity, to have that come outside of the family office. So that's the rough structure of the family office. And Ryan's going to spend a little time here shortly talking about the intricacies of the family then forming a fund to do some investing. But you first establish that you have the family office, and then you decide, how are we going to invest? And frequently what family offices decide is, well, we're going to create a fund and we're going to pool our capital and we're going to invest through that fund. One of the starting places before you even get to that place is to come up with what's called but has different names, but frequently called an investment policy statement or investment guides. Because if you're going to have a family office and it's going to be overseeing investments, and you're going to have many different family members involved, everyone needs to agree on a philosophy, an approach, a plan of attack. And as many people know, if you are involved in the family office world, you're both a professional and also a psychologist sometimes, because you have to deal with all kinds of different family issues. They can be internal family issues or just different philosophies, different life views, conflicts within family. So when you go through this investment policy statement process, it can be a difficult process, but it's usually a healthy result because you've received you have worked through some issues in determining how are you going to invest, who is going to be party, what are your goals, what are your objectives, what are your time horizons, what are your limitations? Many family offices decide that they are going to, not invest in certain things or focus investments in others. So this process is very important to make sure that the family office is unified on the same page, and you're not going to encounter issues down the road. So we go through this investment policy process, and frequently through that process, folks decide that they want to go ahead and create a vehicle for investing the family's assets, and they may create multiple vehicles. You might have multiple funds, funds that focus on certain types of investments, where certain family members are in certain funds and they're not in other funds. But that usually the desire, the plan to have a family fund to manage some of the family assets grows out of this investment philosophy process that the family goes through, that can take some time and requires a significant amount of guidance. While it's not the primary focus of this presentation, I think it's important to note a few things that the family office is not exempt from. And we have seen many issues with family offices in this area. So this is more along the lines of a safety share. But we've also, there's been a fair amount of issues in the news lately as well that have implications for the family office. And these reporting obligations include and these reporting obligations sometimes are triggered by the fact that some family offices have achieved their wealth in part because they have an insider of a public company. It might be an executive officer or somebody who owns a significant amount, significant percentage of a public company. And that's part of the source of wealth for the family. But when you have that person in the family structure and you start to create entities and investment funds, the reporting obligations of that individual can then impact the family investing. And I'll share a couple of examples of that. Insiders, so directors, officers, and 10% owners are subject to what's called Section 16. Section 16 has a reporting obligation, and it also has a liability obligation. If an insider engages in what are called opposite way trades within 6 months of each other, so a purchase and a sale or a sale and a purchase within 6 months of each other, they have to disgorge profits. Now, and they have to report their trading as well. So when you have an insider and they're part of a family office and they're part of these entities, the shares and the trading of those entities can be pulled into this regime. Similarly, in an affiliate of a public company, if they're selling shares that are not subject to a registration statement, they use Rule 144. If they're selling publicly, they'll use Rule 144. That has volume limitations. And so when you have an insider who is part of an affiliate of a public company, again, some of the trading within the family office structure could be pulled into those volume limitations of Rule 144. You might have to aggregate the trading of those different entities. Whether or not you're a director or officer, if any of the entities within the family structure acquire more than 5% of a public company, they'll have to file a 13D or G. You also have the families are often surprised to find that they could be considered a, quote, large trader if they are trading in securities worth 20 million in a day or 200 million in a month. They may be subject to the large trader filing requirements, which would require a Form 13H. We've had several families surprised by that lately. And then finally, there's a Form 13F required for what are called institutional managers. And family offices can be implicated by that rule as well. They may, if they're managing funds that include over 100 million in effectively publicly traded securities, there's a definition of the securities that qualify for this, that trigger this requirement. Then you could be required to file what's called a Form 13F. So those are examples of different types of forms and reporting and liability that the family is still subject to, even if they have an exempt family office, even if they're using the family office exemption. And the structuring within the family office can either make those filing requirements more burdensome or less burdensome. And so when you're structuring your family office, it's worth thinking through what are these other reporting and securities laws that apply to us, and how can we make sure that as we're structuring our family office, we're at least making ourselves aware, making sure we don't slip up, making sure there's a process in place so that we're tracking what we need to report and making sure that we don't trip over any of these rules. And the last thing I'll mention is, this family office exemption that we are talking about right now is a decade old. And there hasn't been all that much drama around this particular exemption. But recently, there was a significant family office that defaulted on margin calls and ended up engaging in a fire sale of 10 billion worth of assets that greatly disrupted the marketplace. And it's caused a flurry of activity and a flurry of focus on family offices, so that the SEC is now saying they're going to look hard at the family office exemption to see if there need to be adjustments And it's kind of interesting because the original analysis of the family office exemption was really looking at the family members and saying, are these the people who need the protection of the securities laws? And so it was determined, these are wealthy families with family offices where they're just focusing on their family assets. They don't need the protections of the securities laws. But the new, this latest round of attention is looking at it from a totally different perspective, which is to say, does the market need protection from the family offices? Are they? Is there too much that's under the radar? And do we need to have greater visibility into what's going on at family offices? So the noise, the clamoring is about narrowing the exemption, having it apply to smaller offices, and making sure that when you have offices, family offices that are controlling a significant amount of securities that could impact the market, that there's some way to get better visibility into what's going on there so you don't have surprises. Most people in the know do not think anything's going to happen to the family office exemption. They think that of course there needs to be noise and analysis, but they think that of course that the family office rule has been really hasn't caused many issues. It's been helpful, and that there isn't a need to do any type of massive overhaul. There could be some additional reporting obligations, but no one thinks that there is any real threat to the concept of the family office exemption. So having set the table with how do you structure your office, what are some of the things you need to be aware of as you go down this path, I'm going to hand the mic over to Ryan to talk through the intricacies of actually forming a family fund and investing in funds. I guess first we have to do a polling question.
Is everyone able to see the polling question on the slide? Amy,
Ryan, you're on mute.
Amy, can you hear me?
Yes, Ryan.
Okay, thank you. So the first polling question, and this is for CPE participation, is just please look at whether or not or consider whether or not a family office may advise non-family members, and go ahead and answer that yes or no, where you can answer the polling question.
Hey, Ryan.
Yes.
Ryan. So we're having some technical issues with our WebEx. So I'm going to ask the attendees that if you could answer all of your polling questions through the chat area. There should be a chat area on your right sidebar, and you can answer. You can add your answer to the polling question through the chat. So if you could do that, if the attendees could do that to answer their polling questions, that would be great. Thank you.
Thanks, everyone. Sorry about that. So I'm Ryan Nichols. I'm of counsel in the corporate group at Holland & Hart. I focus on private investment funds from a investor side as well as a sponsor side, including family office representation. I'm going to start at a very high level this morning before we dive into the actual fund work, just to lay the framework for what we're looking at. At the most basic level, you're looking at family offices taking the form of either a single family office, a multifamily office, or what may be referred to as an embedded family office. As you expect, a single family office, for those of you who aren't already involved, manages the wealth of one family, and it may take advantage of the family office exemption under the Advisors Act that Amy was talking about earlier. Now, a single family office and its investment arm may either be managed by family members or third parties, and its terms and structures are going to be heavily influenced by the families and its individual members' goals. So, for example, generational wealth, education, liquidity, philanthropy, etc. Multifamily offices are those formed to pool the assets of multiple families, and these are typically managed by either a third party but they may also be managed by a lead family office. The approach of the multifamily office allows pooling not only of wealth, but also family office resources and structure. And this provides the opportunity, especially for relatively small offices, to capitalize on what are inherent economies of scope and scale. Now, similar to a single family office, you have what may be referred to as an embedded family office. Serves one office or one family on a much smaller scale, and it typically involves the hiring of third-party professionals serving discrete functions that may be found in a large single-family office. Now, as Amy mentioned before, our focus for this segment is on single-family offices and the high-level considerations that go into establishing a family office fund structure, the vehicles which are used to acquire and hold those investments, and then considerations in retaining and in compensating investment advisors. Now, since Amy already addressed the Advisors Act, I'm going to try not to discuss that again, other than to reiterate now that the family office exemption from registration and other prevailing securities regulatory considerations are also a driving factor in structuring these fund arrangements. Now, although family offices also frequently provide accounting, financial reporting, tax preparation, estate planning, insurance management, etc. services, that's several hours of presentations by a host of more qualified professionals. And so today we're just going to focus on this fund pooled investment aspect for managing family wealth. Now, first of all, let's talk a little bit about what are the benefits and the challenges, the pros and cons of adopting what is a fund structure or a series of funds to invest family office wealth. On the pro side, while trust foundations or other private trust companies may be appropriate structures, and they may even be necessary based on the needs of the individuals within the family, sometimes it may be prudent to adopt a fund structure, for example, in situations where managing a series of investments across a large family's individual accounts on an investment by investment basis is overly burdensome, and pooling investments into one or a series of funds may be the best means to manage and deploy capital efficiently and effectively. Now, these structures also put control over investments and decision-making into the hands of the family office, whether in their capacity as the investment advisor or in their relationship with an external investment advisor, much in the same way that a sponsor or general partner of a private investment fund would. Another pro is the aggregation of family wealth provides greater leverage and the ability to negotiate more favorable investment terms and allocations with third-party funds and investment opportunities. These fund arrangements also inherently allow for competitive compensation, which I'll discuss a little later on, but by aligning the interests of the fund managers and the families through charging of asset management fees or the payment of carried interest. Finally, this structure may better facilitate asset diversification and unique allocations among family members based on their particular needs. This is less the case in a single family, single fund situation. However, the formation of additional funds based on asset strategy, risk tolerance, region, etc., may be accomplished through either multiple partnerships or even through a series LLC where it's available. Challenges or cons to using a fund for a family office investment structure: it may not necessarily get the younger generations involved in the management of the assets without effort. So, for example, the family leadership or those third parties to whom they've delegated the authority are responsible for managing these investments, and without the specific education and appointment into management positions, the younger generations may not participate. Obviously, that's to be structured by the family and the fund itself. It's also, these are complex, and there's a lot of cost on a cumulative basis that results from implementing these structures. So as you add a new fund, as you add a new SPV, you're going to add another tax return. You're going to add another entity or several. You're going to add another bank account, and you're also going to add other areas of expertise where you need management. The last thing I would say in this regard is the family office always needs to be aware of the security implications and regulations that are highlighted by Amy earlier. And for example, these don't necessarily mean make sure you're exempt based on the people investing in the fund. You also need to make sure that the activities of the fund, for example, being a controlling party in a joint venture portfolio company, could have implications under the Advisors Act if you're seen to be advising non-family members. So there's a whole host of issues to keep in mind, pros and cons, and it's not going to be for every family office. So at its core, the basic fund structure is the same as you would see in general private investment fund, whether it's a hedge fund, a private equity fund, a venture capital fund, et cetera. The family members are partners or members in the investment fund, and that's managed by a separate entity, which is the manager of those assets. Now, as Amy alluded to earlier, unlike traditional private investment funds, there are family dynamics at play, and individual family member needs and priorities that must be taken into consideration. So the governing documents for these vehicles need to reflect those considerations, which are likely to be significant compared to a return-driven non-family investment fund. So in addition to more typical investment structure terms, the family office members also need to consider the desired strategy or asset class, admissions, liquidity rights, events of divorce, addition of new generations, spousal consent requirements, active investment by family members, if any, risk tolerance of the family members and the generations. Perhaps younger generations are less risk averse. Any cultural, societal impacts, desire for philanthropic pursuits, and then tax and estate planning. Now, the last point here, which I would make, is that for why is this different than a typical private fund? Consider as well that the office is negotiating the individual fund structure with the family members and their advisors, and the terms are going to be heavily influenced by the respective lawyers and tax professionals representing those individuals. Many of these, hopefully all of these, individuals are experts in estate planning, tax structuring. However, and I don't say this with any intent to disparage, those individuals may not necessarily have the investment experience that would counsel to an institutional investor that's able to negotiate fund terms with a private fund sponsor. And so this will result inevitably in additional atypical fund terms specific to the needs and interests of the various family members. Here I'm going to talk a little bit about considerations in engaging and retaining investment managers. So whether the office is managed internally by family members and employees of the family office or by a third-party advisor, the manager's conduct and the focus of the investments is going to be in accordance with the investment policy statement, which defines the investment goals and objectives of the family. Amy talked about this earlier in greater detail, so I won't go into it other than to say it's critical that whoever the advisor is has a clear understanding of the memorialized investment policy statement. As far as documentation goes, you're going to end up needing investment advisory agreement to set forth obligations, compensation, etc. Now, the rationale, why would you engage this may be obvious to many of you, but why would you engage a outside advisor as opposed to keeping an investment advisor internal? And I think the argument is, we'll talk about some tax considerations later on, but some of the arguments are the same as in a private investment fund context. Maybe some of the family members aren't qualified to be advising with regard to a certain asset class if they made their wealth in another completely different venture. Maybe the family members are interested in pursuing, as I said before, they just want to sit on a governing board of the family office, and instead they want to pursue educational, giving, recreational, or other activities. And so being able to utilize a investment advisor structure is a good way of freeing them up to use the wealth that they've built in meaningful ways. Now, compensation for investment advisors, as I said, I'm going to talk about this briefly on the next slide where I highlight some tax considerations. As we've discussed, family offices and their fund vehicles deviate from traditional investment funds, but the office still needs to pay market rates via a competitive compensation structure. Now, these family offices are going to be competing not only with large family offices, but with any other investment management group or investment fund, whether it's hedge funds, private equity funds, you name it. So among the fundamental choices that you're going to have to make is, how important is simplicity in establishing a compensation structure versus making sure you're competitive in your hiring and you're aligning the interests of the family with its advisors and employees. So if it's in the interest of the family office to keep advisor compensation simple, well, then it can try to offer a competitive base salary and discretionary bonuses just tied to results. They could also offer perks, whether it's the right to use the boats or the planes or the ski in, ski out house in Vail. And what I'll say is this may make sense for an embedded family office serving discrete needs. This approach may no longer be sufficient for a single family office, or certainly not for a multifamily office. So family offices looking to offer competitive compensation will seek to align the interests of the advisor with the family. So it's going to look more like a traditional investment fund and include the right to share in carried interest, investment and co-investment opportunities, as well as receiving bonus payments. And the offering carried interest also includes tax advantages from the perspective of receiving capital gains treatment. The last note here is, when you're considering investment advisor compensation, you need to take care to avoid layered fees. So if you're pooling investments at a fund at the family office level for the purpose of making investments, those investments could be in other funds or vehicles that charge fee and carry. So the family office counsel is going to need to negotiate with advisors up front so that either the lower tier investment fees are offset against the advisor's management fees, or so that the capital contributed to those lower tier funds are not actually counted as assets under management for the purpose of calculating family office advisor compensation. So I'm going to take a swing. My area is not in tax planning. However, this is a very important consideration. I'm going to keep it at a relatively high level, and to the extent that anybody wants to discuss the additional nuances and factors I'm going to be putting out, or our team's happy to have a discussion at that level. What I'll say is, so the tax code has drawn a distinction between expenses incurred in connection with a trade or business, which themselves are generally deductible, and then investment expenses for which there is not currently a deduction. The Tax Act, the 2017 Tax Act, suspended the rules that permitted deductions for expenses incurred for the production of income or investment expenses between 2018 and 2025. So absent further legislation after 2025, these expenses will once again be deductible, but again, subject to a floor of 2% of the taxpayer's adjusted gross income. Now, generally, management of investments for a family does not constitute a trade or business. So just because a family member is serving as the advisor does not in and of itself change the character of the expenses incurred during the course of its activities from that of an investment to that of a trade or business. And that could be anything from salaries to rent to tech, cybersecurity. Any expenses that they're incurring are not necessarily going to be the result of a trade or business. Now, a 2018 case of lender management provided funds with an avenue for an affiliated family office investment advisor to be deemed to be operating a trade or business. In lender, activities of a family office that provided extensive family planning services, extensive investment management services, accounting, and other services to a broad group of family members could be considered to be a trade or a business and therefore deductible. And without limitation, including under the 2% floor when it comes back into play. Now, I'll note that not every family office will be able to or will want to undertake to implement the structure provided by the lender case to treat investment management expenses as ordinary and necessary business expenses. However, for those who want to meet the high hurdle established by the tax court, here's a list of a few non-exclusive factors that are going to be important. So the ownership of the group of managers, should not mirror that of the investment fund. There will need to be some meaningful difference there. The manager and lender was compensated through carried interest distributions from the fund, so it was participating in profits. The family members operated management company that operated the management company did so on a full-time basis. That was their job. The compensation to the manager was separate from and in addition to any amounts received by those controlling family members from their capital interest investments in the underlying fund. And there was also a right for family members to withdraw their investments subject to any appropriate liquidity requirements that were in the governance documents. So as I mentioned, very broad overview of the important tax consideration here, but some serious implications and really important if from a structuring perspective up front. So I definitely urge, if you're looking to take the lender path, that you consult with appropriate tax counsel as well. So our next polling question, and then I will turn over the presentation, is which of the following considerations are significant to family members and their representatives in connection with forming single-family office investment vehicles? And take a look at those. We have investment policy statement, engagement or management by the family members, estate tax planning considerations, line of business or assets pursued, or all of the above. So I apologize if we still don't have the poll working. So please, if you want to participate, go ahead and we'll keep track of everybody who does. So I'll give you a couple of seconds while I prepare to turn the presentation over to Leah Newman, who's an associate in our group. And she's going to discuss family office deployment of capital in third-party investment funds and is going to address steps to ensure compliance with investor suitability and qualification requirements. And what I'll say is once Leah's done, we'll take a look, and I believe there may have been some questions early on. We'll see if there's any questions other than responses to the polling questions in the Q&A and see if we're able to answer those in real time. So thank you, Leah.
Thanks, Ryan. Hi, everyone. My name is Leah Newman. As Ryan mentioned, I'm an associate in the corporate group, and my practice specializes in securities and capital markets work. So to this point in the presentation, we've focused on family offices and considerations for structuring of family offices. Next, we're going to be speaking about family offices that are investing in funds and ensuring compliance with investor qualification requirements. Family offices will often find that there is a considerable amount of information asked by investment funds before a family office is allowed to invest. And it's important for investors, especially family offices that tend to be more private and have privacy concerns, to really understand why these questions about investor qualification are being asked. So first, we'll briefly discuss the key investment documents related to an investment in a fund. Oh, and sorry, let me switch the slide. Next, we'll discuss the importance of investor qualification. And last, we'll talk about how family offices can prepare for and document their investor qualifications. So let's first talk about key investment documents related to an investment in a fund. Offering documents are the documents that are provided to a prospective investor prior to that investor making an investment. And there are three main agreements. The first is the private placement memo, or the PPM, which is a securities disclosure document that provides investors with material information about the fund to enable an investor to make an informed decision. It's similar to a prospectus in a public offering, and it provides information to investors about the terms of the fund, the structure of the investment, the background of the managers or the GP, and other disclosure issues, including certain risk factors that investors should be aware of. The next document is the limited partnership agreement or the operating agreement, depending on whether the fund is structured as a partnership or an LLC. The agreement outlines the terms of the fund and the rights of an investor in relation to the fund. The terms will vary, but it will always cover things like the powers and activities of the general partner or the manager, any fees and expenses, including management or performance fees, how distribution of profits and losses are made to all partners, and certain withdrawal provisions. And then the last major offering document is the subscription agreement, which includes what's called an investor questionnaire. And that's largely what we'll focus on in this presentation. So a subscription agreement provides investors with a description of the steps that they need to take to actually invest in the fund. And it provides the fund with eligibility information about the investor. This is the investor's contract with the fund, and it specifies the investor's subscription amount and outlines the terms under which the investment will be made. So next, let's talk about the importance of investor qualification to funds and how a family office may qualify to invest in an investment fund. So investor qualification is an integral part of managing in an investment fund. The type and character of each investor affects, among other things, whether an investor qualifies to invest, whether the fund would be required to register with the Securities and Exchange Commission, and the fee that can be charged of investors. As an investor, it's an important part of investing to understand the different categories of investor qualification that funds are focused on to enable you to be qualified to invest in different funds and avoid having your investment denied for various reasons. And then also to be prepared for the types of questions that will be asked of you and the types of documents that may be requested by the fund in the different subscription documents. So there are three major investor qualification statuses. of particular importance to fund investments: accredited investor status, qualified purchaser status, and qualified client status, each of which we'll discuss. The first is AI status. And so under the Securities Act, a company that offers or sells its securities must register such securities with the SEC unless an exemption from registration is available. A commonly used exemption is found in Rule 506 of Reg D. And to get the greatest benefit from this exemption, a company must sell its securities only to accredited investors. Of importance for funds, a fund offering or selling its securities only to AIs would not be required to register such securities with the SEC. Additionally, the Investment Company Act exempts from the definition of quote unquote investment company many types of entities that would otherwise be required to be subject to the regulatory requirements of the Investment Company Act. However, privately held investment companies are exempted from regulation if they satisfy two requirements. First, it must not make or propose to make a public offering of securities. And second, it must not have more than 100 beneficial owners of its securities. Therefore, a pretty straightforward manner of complying with the first requirement would be to have the fund comply with Rule 506 by only selling securities or its interest in the fund to accredited investors. There are more than 20 categories under which an investor may qualify as an accredited investor, and the SEC updated the list of categories about 2 years ago. And there are numerous tests related to net worth, income, assets under management, professional knowledge, and a number of other categories. However, of importance for family offices, the SEC recently adopted amendments that adds 2 new categories of accredited investors for, first, family offices, which is the definition used under the Advisors Act. And so it's family offices with at least $5 million in assets under management that are not formed for the specific purpose of acquiring the securities, and whose investment is directed by a person who has the knowledge and expertise in financial and business matters that the family office is capable of evaluating the merits and risks involved in the prospective investment. And the second category of note is that of family clients. So it's a family client of a family office, meeting the criteria specified above. The new categories may be appropriate for qualifying a family office or a family client as an accredited investor, but we would recommend that you check with counsel because there may be other categories under which the office also qualifies. The next category is that of qualified purchaser. The Investment Company Act excludes privately held investment companies from falling within the definition of investment company if it's not making a public offering and the company's securities are owned exclusively by qualified purchasers, which term is defined in the Investment Company Act as a individual, a trust, or importantly for family offices, an entity owned by family members that owns not less than $5 million in investments and was not formed for the purpose of investing in the fund. The term investments is pretty broad. It includes stocks, bonds, real estate, and other assets held for investment purposes. So by selling securities not in a public offering and only to qualified purchasers, a fund would be excluded from regulation under the Investment Company Act. And further, funds that exclusively have investors that meet the qualified purchaser standard can have an unlimited number of investors, whereas funds that don't sell exclusively to qualified purchasers, have a cap of 100 investors or less. And then the last category of investor qualification to note is that of qualified clients. And the importance here is that as a general rule, the Investment Advisors Act prohibits an advisor registered with the SEC from charging clients a performance fee. However, there's an exemption, and one such exemption from this permits an investment advisor to collect performance fees, such as carried interest, which is very important for funds, may charge that fee of qualified clients. A qualified client is an individual, a qualified client is an individual or company who maintains at least 1.1 million of assets under management, a company with more than 2.2 million in net worth, or an individual or company that the advisor reasonably believes is a qualified purchaser. So now that we've discussed why each of those investor qualifications are important to funds that family offices may be investing in, let's talk about how family offices can prepare for and document their investor qualifications. It's helpful for family offices to prepare for the questions that may be asked of them and the documentation that may be requested in connection with making an investment. Family offices would be well advised to sit down with their legal counsel or tax advisors and go through the process of determining if and how the family office qualifies as an accredited investor, qualified purchaser, and qualified client. It can be a useful exercise to walk through a standard list of questions asked by funds to determine how the family office would complete an investor questionnaire. In connection with an investment in a fund by a family office, in addition to the investor questionnaire, the fund will also require that certain documentation be delivered to support the investor's statements about how it's qualified and address certain know your client and anti-money laundering rules. For family offices, the documentation will often include tax form such as a W-9, government filings such as a certificate of formation, governing documents such as an operating agreement or partnership agreement, the identities of individual partners or members, and potentially identification for such persons such as passport pictures. And then in certain instances, primarily if general solicitation is used in the offering, the family office's financial information may need to be provided to confirm that the family office is in fact accredited. So for family offices that are private, the documentation may feel intrusive. However, we hope that by discussing with counsel why this information is being requested, it can provide a level of comfort. And again, it's wise to prepare for and collate the information that may be required. And so I know we're running a little tight on time, so I will just say thank you for all the participants for attending today. And with that, I will open the floor for any questions that have come into the chat.
I think we need to do the one final polling question.
Oh, I apologize. You're correct. Here's polling question number 3. So 3 investors apply to invest in a private equity fund, which constitute a qualified purchaser.
There is a question that came into the Q&A section. I don't know if you guys can see that or if you'd like me to read it to you.
I can see it. I'm happy to respond to it. The question is with respect to foundations or nonprofits that the family sponsors, is there a carve out or an exemption that allows a certain amount to come from people outside of family clients? And And there's not. That's one of the sticking points, is that it has to come from family clients, people who can be served by the family office. And I'm happy to talk about that further offline if there are other questions in that area.
Well, thank you, everyone. We're happy to stand here for another minute or so, but it looks like we are just about out of time, and there aren't any other questions coming in. So we'll hang out for another minute, but otherwise have a great day. And we will be having our next presentation a few months from now. We're going to be focusing on, I think we're going to be in January, and we're going to be focusing more specifically on a broad overview of private investment funds from the perspective of sponsors, general partners. So hope to see you then.
Thanks.